The concept of financial freedom has been co-opted. It has been distilled into a simple, intoxicating formula. Save aggressively, invest passively, and escape the drudgery of work by 40. It's a narrative sold in best-selling books and amplified across countless blogs and forums, promising a life of perpetual leisure funded by a well-tended portfolio. But this narrative, in its seductive simplicity, obscures a more complex and costly reality. We, as professionals, as strategists, as individuals accustomed to analyzing complex systems, must look beyond the surface-level arithmetic. We must ask a more incisive question. What is the true all-in cost of financial freedom? The cost is not a number. It is not 25 times your annual expenses. That's merely the price of admission. The true cost is measured in unseen trade-offs, in miscalculated risks, and in the profound psychological burdens that the pursuit of this goal can impose. Yet today, we will dissect this popular ideal, moving beyond the simplistic calculations of the FIRE movement. Financial independence, retire early, to a more sophisticated understanding of wealth, work, and life. Let's begin with the foundational premise. Financial freedom is typically defined as the point at which your passive income from investments exceeds your living expenses. The most common heuristic for achieving this is the so-called 4% rule. This guideline, derived from the 1998 Trinity study by 3 finance professors at Trinity University, suggested that a retiree could safely withdraw 4% of their initial portfolio value, adjusted for inflation, each year for 30 years with a very high probability of not depleting their funds. This simple rule gave birth to the inverse, the 25x rule, which states you need to accumulate 25 times your annual expenses to achieve financial independence. It's elegant, it's quantifiable, and for many, it becomes a financial North Star. But relying on this 30-year-old study as gospel for a 50 or 60-year retirement is fraught with peril. The original study assumed a portfolio of at least 50% stocks and a 30-year retirement horizon. What if your early retirement spans 50 years? What about the sequence of returns? The creator of the 4% rule himself, William Bengen, has since revised his own guidance, suggesting a 4.5% or even 4.7% withdrawal rate is now feasible under certain conditions, while prominent financial planner Michael Kitchis argues that in today's market environment with lower expected returns, a rate closer to 3.5% might be more prudent for long-term planning. The very foundation is not as solid as we are led to believe. It is a probability, not a certainty, and it ignores the most significant costs. The first and perhaps most insidious of these costs is opportunity cost, specifically as it relates to your human capital. The standard FIRE playbook calls for an extremely high savings rate, often 50% or more, starting in your 20s and 30s. This is achieved through aggressive frugality and maximizing income in a stable, high-paying career. But consider the trade-off. Your 20s and 30s are the peak years for investing in your own skills, network, and earning potential. This is the period when your human capital, the present value of your future lifetime earnings, is your single greatest asset. According to a 2019 report from the Federal Reserve Bank of New York, the steepest earnings growth for college-educated workers occurs before the age of 40. Every dollar you divert from investing in yourself, whether that is for an advanced degree, a specialized certification, a calculated career risk like starting a business, or even relocating for a pivotal job opportunity, is a dollar that could have generated a far greater return than the market average. By optimizing solely for your savings rate, you may be systematically underinvesting in the very engine of your wealth creation, you. An S&P 500 index fund might return an average of 10% annually before inflation, but the right career move or educational investment can increase your income by 20, 30, or even 100%, a return that dwarfs passive investing in the early stages of a career. The relentless focus on minimizing expenses can lead to a dangerously risk-averse mindset, causing you to cling to a stable but capped income job rather than pursuing an entrepreneurial venture with asymmetric upside potential. The true cost here is the future, more successful version of yourself that you chose not to become. Beyond the financial opportunity cost lies the psychological toll. The journey to a high savings rate is not a passive activity. It is an active, daily process of restriction and optimization. This can cultivate a scarcity mindset that is difficult to shake even after financial independence is achieved. Researchers like Dr. Brad Klontz, a financial psychologist, have documented how our financial behaviors become deeply ingrained habits. The person who spent 2 decades optimizing every purchase and agonizing over every expense does not simply flip a switch and begin to enjoy their wealth. They often become what we call fearful savers, unable to spend the money they've accumulated, constantly worried about market downturns and portfolio depletion. They win the game but forget why they were playing. Chasing a net worth goal too hard can make you miss out on life. Don't skip social events. Good relationships bring happiness, so enjoy life while saving. This brings us to the technical costs, the complex, unsexy realities that are often glossed over in the popular discourse. The first is tax drag. Achieving financial freedom is not about your gross savings, it's about your after-tax, risk-adjusted returns. Tax loss harvesting means selling investments at a loss to lower your tax bill. A Vanguard study shows it can boost your returns by up to 0.75% a year. Next, we must confront the healthcare conundrum. For an early retiree in the United States, this is not a line item. It is a monumental financial hurdle. Before the age of 65, you are on your own. You must navigate the Affordable Care Act marketplace, where premiums can be substantial, even with subsidies. A 2023 analysis by the Kaiser Family Foundation found that the average benchmark premium for a 40-year-old was over $450 per month. For a family, this can easily exceed $10,000 or $15,000 per year, and that's just the premium. These plans often come with high deductibles and out-of-pocket maximums, meaning a single major health event could cost you an additional $5,000 to $10,000. Many in the FIRE community plan to manage this by keeping their taxable income low on paper. But to afford healthcare, you must live a life of artificially low realized income. This constrains your spending and liquidity, forcing you to perform a delicate dance of Roth conversions and careful capital gains harvesting. It makes your retirement incredibly fragile and dependent on the whims of healthcare policy. This is a massive, ongoing, and unpredictable cost that the simple 25x rule utterly fails to account for. Then there is the beast known as sequence of returns risk. This is perhaps the single greatest threat to an early retiree. Standard retirement models are based on average long-term returns, but you do not experience average returns. You experience returns in a specific sequence. If you retire and are immediately hit with a significant market downturn, like the one in 2008 or early 2020, you are forced to sell assets at depressed prices to cover your living expenses. This permanently impairs your portfolio's ability to recover. Selling shares at the bottom has a much more devastating long-term impact than selling them at the top. A study by financial researcher Wade Pfau demonstrated that a portfolio could have the exact same average return over 30 years in 2 different scenarios, but if the bad returns come early, the portfolio fails. If they come late, it succeeds with money to spare. This return path dependency means that the 4% rule is not a static number. It is highly dependent on the market environment in the first 5 to 10 years of your retirement. Mitigating this risk requires a more sophisticated strategy than a simple 60-40 portfolio. It might involve building a bond tent, increasing bond allocation just before and after retirement, or holding several years of cash reserves, or using more complex options-based strategies to hedge against downside risk. Each of these strategies comes with its own costs, either in reduced potential returns or direct expenses, further complicating the simple math of financial independence. Finally, we have to talk about inflation in a more nuanced way. We usually think of inflation as that 2% or 3% number from the CPI, but no one experiences the average inflation rate. You experience a personal inflation rate dictated by your specific consumption basket, and the costs of the things that matter most, healthcare and education, have historically outpaced the CPI by a significant margin. According to the BLS, from 2000 to 2022, the overall CPI increased by about 75%. In that same period, medical care costs rose by over 130%, by over 175%. If your financial plan is based on your portfolio outrunning a generic 2% or 3% inflation rate, you are systematically underestimating your future liabilities. A successful plan must account for differential inflation across categories. This requires a more dynamic asset allocation, perhaps with a greater weighting toward assets that have historically provided a better hedge against inflation, like real estate, commodities, or treasury inflation-protected securities, TIPS. It requires stress testing your plan not against average inflation, but against prolonged periods of high inflation in the sectors that will represent your largest expenses in retirement. Given these immense, often hidden costs, the opportunity cost to your human capital, the psychological burden, the tax drag, the healthcare labyrinth, and the technical risks of sequence and inflation, it becomes clear that the conventional model of financial freedom is flawed. It is a brittle, rigid goal that demands the sacrifice of your most productive and vibrant years for a future that is far less certain than the spreadsheets suggest. So what is the alternative? The alternative is to shift our objective from financial freedom to financial agency. Financial agency is not about escaping work. It is about gaining the power to choose your work. It's about having the capital base to dictate the terms of your engagement with the professional world, not severing ties with it entirely. It's the ability to say no to a project you don't believe in, to take a 6-month sabbatical to reskill, to downshift from a high-stress corporate job to a more fulfilling role, even if it pays less. It's the power to start your own business, knowing you have a financial cushion to absorb the initial lean years. This reframing changes the entire strategy. Instead of a single monolithic FI number, you build a tiered system of financial resilience. The first level might be a robust emergency fund, 6 to 12 months of expenses, that grants you the agency to walk away from a toxic work environment without desperation. The next level could be what the community calls Coast FI, where you've saved enough in your retirement accounts that, without any further contributions, it will grow to support a traditional retirement. Reaching this point, perhaps in your late 30s or early 40s, dramatically liberates your career choices. Your primary income no longer needs to be funneled into savings. It can be used to support a more intentional lifestyle or to take calculated professional risks. Beyond that, you might aim for Barista FI, having a large enough portfolio that you only need a part-time, low-stress job to cover your current expenses while your investments continue to compound. This is a state of immense agency, allowing you to pursue passion projects or spend more time with family long before a full traditional retirement would be possible. This approach, building wealth for agency rather than for escape, recalibrates the cost-benefit analysis. It encourages a balanced investment in all of your assets, not just your financial portfolio. The true assets that create a resilient and fulfilling life are your human capital, your skills and earning power, your social capital, your network and relationships, and your health. An intelligent financial strategy does not sacrifice these for the sake of an accelerated savings rate. It uses financial capital as a tool to enhance them. Money is used to buy back time, to invest in education, to nurture relationships, and to protect your health. For 7 years running, the world has been told a comforting story. A story about a small northern nation that unlocked the secret to human contentment. Finland, the happiest country on earth. It is a headline that feels like a warm blanket in a cold world. A promise of pristine lakes, silent forests, and a society that just works. But this story, the one celebrated on news channels and in glossy magazines, is a fairy tale. And it's about to end, because behind the calm, a brutal, quiet war has begun. A war for Finland's soul, where the casualties are the very people who were promised a paradise. The illusion of Finnish perfection is a powerful one. It's built on images of saunas, northern lights, and a social contract so strong that trust is the national currency. Free, world-class education. Universal healthcare that catches you from the cradle to the grave. Unparalleled safety and equality. For decades, this system was the envy of the world, a shining example of what a nation could achieve when it put its people free. That foundation was rocked by a political earthquake. A new right-wing government came to power, looked at the bill for paradise, and decided the price was too high. What came next was nothing short of a declaration of war on the Finnish way of life. Billions of euros in austerity cuts were announced, targeting the pillars of the welfare state. Unemployment benefits were slashed. Housing support was gutted. Access to public health care was restricted. The changes were so sudden, so severe that they sent a shockwave through the nation. The country that prided itself on harmony suddenly found itself facing massive nationwide labor strikes, with workers pouring into the streets to protest the dismantling of their future. The veneer of perfection didn't just crack, it was shattered by the sound of its own government tearing down the dream. But this brutal shift didn't happen in a vacuum. It was the final, jarring note at the end of a very different song. Just a few years ago, the face of Finland was Sanna Marin, a prime minister who became a global icon of progressive, youthful leadership. She represented a modern, vibrant Finland, a nation that could be both responsible and cool. Then, videos surfaced of her dancing and celebrating at a private party. The international scandal that followed, dubbed Partygate, was about far more than a politician letting her hair down. It became a cultural flashpoint, a battle between an older, more conservative Finland and a younger generation that saw nothing wrong. Her eventual election loss and the rise of the new, austere government felt like a national hangover. The party was officially over. Sanna Marin's era now looks like the last glimpse of a carefree dream before the country woke up to a crushing economic reality. The debate over her leadership exposed a deep fracture in the Finnish identity, and her fall from grace became a chilling symbol of a nation turning its back on a more optimistic future, choosing instead a path of painful sacrifice. And the deepest, most disturbing sacrifice might be the one happening inside the minds of the Finnish people. For years, experts have been baffled by a dark paradox lurking beneath the happiness surveys. How can the world's happiest country also have one of Europe's highest rates of antidepressant use? How can a society built on community suffer from a silent epidemic of loneliness, especially among its youth? The answer may lie in a celebrated national trait, sisu. It's a word that means stoic determination, resilience, and the quiet endurance of hardship. It's the spirit that helped Finland survive brutal wars and harsh winters. But some now believe the same cultural strength has become a prison. A pressure to remain silent, to never complain, to put on a brave face even when you're falling apart inside. The happiness surveys measure how satisfied people are with their lives, not how they actually feel day to day. And in Finland, it seems millions are satisfied with a life of quiet, dignified suffering, creating a fortress of silent misery hidden behind a smile. This isn't happiness. It's the perfection of emotional control. And it's breeding a mental health crisis that no global ranking can measure. This internal crisis is now colliding with an external one. In 2023, Finland made a historic decision to join NATO, ending decades of military neutrality to shield itself from Russian aggression. To the outside world, it looked like a smart, defensive move. But inside Finland, it came with a staggering, unspoken price tag. To meet NATO standards, the government committed to a massive military spending spree, including a $10 billion deal for state-of-the-art F-35 fighter jets. This decision was made at the exact same time the government began swinging an axe at social programs. While new mothers were seeing their benefits cut and unemployed workers were losing their safety nets, the nation's wealth was being funneled into advanced weaponry. It created a grim and unspoken reality. Finland was arming itself for a potential future war by bankrupting the very peace and stability its citizens cherish today. The government was choosing guns over butter, and for the average Finn, the cost of national security suddenly meant personal insecurity. But even the most advanced military cannot fight an enemy that is already inside the gates. Demographics. Finland is facing a mathematical death spiral. Its birth rate has plummeted to one of the lowest in Europe, far below the level needed to replace its population. Meanwhile, its people are living longer than ever. The result is a demographic time bomb. A rapidly shrinking number of young workers is being forced to support a rapidly growing number of retirees. The entire welfare state was built on a pyramid scheme that required each generation to be larger than the last. Now the pyramid is upside down, and the system is on the verge of collapsing under its own weight. The logical solution would be mass immigration to bring in new workers and taxpayers. Instead, the new government is doing the exact opposite. Fueled by nationalist sentiment, they are enacting some of the strictest anti-immigration policies in Europe, making it harder for foreign workers to come and even harder for them to stay. It's an act of national self-sabotage, a country with a fatal disease refusing the only known cure. Finland is knowingly locking its doors while the population inside slowly dies out. For those living outside the major cities, the future has already arrived, and it looks like a ghost town. The competitor's video mentioned automation, but it failed to capture the chilling reality on the ground. In rural Finland, technology hasn't just improved efficiency, it has erased entire communities. Highly automated timber mills and paper factories that once employed thousands now run with a skeleton crew of a few dozen technicians. AI-driven logistics have replaced truck drivers, and remote service centers have eliminated local jobs. The result is a landscape of quiet, perfectly maintained towns, where almost no one under the age of 50 lives. The schools are closing for lack of children. The local shops are shuttered. The young have fled to the cities in search of jobs that are themselves becoming scarcer, leaving behind an aging population trapped in a high-tech museum of what their country used to be. This isn't progress, it's a slow, creeping erasure, a society so efficient that it no longer has room for its own people. All of this has ignited an unspoken war between generations. The baby boomers, who came of age during Finland's golden era, got the full benefit of the deal. They received free education, enjoyed secure jobs, and are now retiring with generous pensions, all funded by the system they built. But their children and grandchildren are inheriting a broken contract. The youth of Finland now face a brutal reality. They are being asked to pay some of the highest taxes in the world to support a system from which they will never receive the same benefits. Student aid is being cut, making education more difficult. Housing benefits are vanishing, making it impossible to afford a home in the cities where the jobs are. And they are being told to work longer for a pension that shrinks every year. It has created a deep, simmering resentment. The young feel like they are paying for a party they were never invited to, while the older generation watches, insulated from the consequences. It is the ultimate paradox of the welfare state. A system designed to create equality is now breeding the most bitter inequality of all, the one between the past and the future. So, when the world crowns Finland the happiest country on earth, what are they really celebrating? They are celebrating a memory. A beautiful, humane idea from a bygone era that is now being kept alive on borrowed time and borrowed money. The Finland that wins awards is a phantom, a nation sustained by a reputation that no longer matches its reality. The real Finland is a country at a crossroads, caught in a perfect storm of austerity, a silent mental health crisis, demographic collapse, and a bitter generational divide. Its leaders are being forced to make impossible choices, dismantling the very things that once made them exceptional in a desperate bid to stay afloat. The question is no longer whether the Finnish dream can continue, but what will be left once it's gone. Because when you strip away the free healthcare, the generous benefits, and the social safety nets, what remains? A cold, dark country with an aging population, a shrinking economy, and a haunting memory of the paradise it once built, right before it was forced to tear it all down. History may remember Finland not as the happiest country in the world, but as the one that showed us that even paradise has an expiration date. What if the downfall of every great empire in history wasn't an accident, a war, or a stroke of bad luck? What if it was a formula, a hidden code embedded in human nature that predicts with terrifying accuracy when a superpower will rise, when it will rule, and when it will inevitably collapse? For centuries, historians believed the fate of nations was chaotic and unpredictable. But they were wrong. There is a pattern, a sequence of 7 stages that has played out time and time again, from the sun-baked stones of Rome to the fog-drenched streets of London. And the most unsettling part? This ancient code reveals that the United States is not in the beginning, or even the middle, of its story. It has already entered stage 6, the final stage before the end. This isn't a prophecy, it's a historical blueprint, a countdown that has already begun. And we are living through the last quiet moments before the clock runs out. It all started with a man who saw what no one else did. Sir John Glubb was a British general, an explorer, and a historian who spent decades living among the ruins of ancient civilizations. As he studied the rise and fall of the Assyrians, the Persians, the Romans, and the British, he stumbled upon a chilling discovery. Empires, he realized, seemed to have an expiration date. Despite their vast differences in technology, religion, and geography, their lifespans as a dominant power were shockingly consistent, about 250 years. From their initial explosive growth to the final, bitter implosion, the pattern held. It was like a biological clock, ticking down to a predetermined end. Glubb called it the fate of empires, a predictable cycle driven not by invading armies, but by a decay that grows from within. It begins with an age of pioneers, an explosion of courage and innovation. Then comes an age of commerce, of immense wealth and influence. Then an age of intellect, of art and science. But then the rot sets in, an age of decadence, a time of pessimism, division, and financial ruin. Every single empire had followed this path. And what his findings revealed was that America, born in 1776, was entering that same dangerous 250-year window. But that was just the beginning of the story. The real proof lies in the stages. Every great nation begins with a fire in its belly, a sense of shared purpose that makes the impossible seem achievable. For America, this was the post-World War II era, a generation that had survived the Great Depression and defeated 2 of the most fearsome military machines in history, came home not to rest, but to build. They created the modern middle class, laid highways across the continent, and put a man on the moon. They believed in themselves and in their country. It was the age of pioneers, reborn. But victory is a slow-acting poison. Soon, that sense of purpose curdled into arrogance. The nation began to see itself not as a leader, but as the world's indispensable ruler. This led to the age of overreach. Instead of building at home, America began policing the world. Decades-long wars in Vietnam, Afghanistan, and Iraq drained trillions of dollars, and more importantly, the nation's focus and unity. Each conflict was sold as essential, but together they formed a pattern of a nation stretched too thin, fighting shadows on the other side of the world, while its own foundations began to crack. The empire was trading its long-term health for dominance, but the most catastrophic damage wasn't happening on the battlefield. It was happening in the one place that holds it all together, the treasury. For an empire addicted to spending, reality is the ultimate enemy. And on August 15, 1971, the United States decided to divorce itself from reality. On that day, President Nixon announced that the US dollar would no longer be backed by gold. In an instant, the very definition of money was changed. It was no longer a claim on a real, tangible asset. It was now a promise backed by nothing but faith in the government that issued it. It was the ultimate blank check. This single act unlocked the door to the next stage, the debt spiral. Without the discipline of gold, the government could print and borrow with no real limit. And it did. The national debt, which had been manageable for decades, exploded. Today it stands at an incomprehensible $34 trillion, a number that grows by $1 trillion every 100 days. It's a fatal addiction. It's like a family that stops earning and starts living entirely on credit cards, throwing lavish parties and buying expensive cars, all while knowing that one day the collectors will come knocking. This is the stage where an empire consumes its own future to pay for the present. The currency is debased, the savings of its citizens are silently stolen through inflation, and the entire system becomes a fragile house of cards, waiting for a single gust of wind to blow it all down. And what happens when the money becomes a lie? The society it's supposed to hold together begins to fall apart. When the economic foundation of a nation rots, the culture is next to go. This is stage 5. Social decay. It's a quiet civil war, fought not with guns but with words, beliefs, and a deepening sense of resentment. A scientist named Peter Turchin calls one of the key drivers of this stage elite overproduction. Essentially, a society begins producing far more highly educated and ambitious people than there are positions of power for them to fill. This creates a ruthless, zero-sum competition where political rivals see each other not as opponents, but as existential enemies. The symptoms are all around us. A 24/7 news cycle that profits from rage and division. Social media algorithms that push us into ideological echo chambers. A nation where two neighbors can look at the exact same set of facts and come to two completely different and hostile conclusions. We've lost a shared sense of reality. The virtues that once defined the nation, hard work, community, sacrifice, are replaced by vanity, victimhood, and perpetual outrage. The empire that once conquered the world now can even agree on what a country is for. This internal fracturing sends a powerful signal to the rest of the world. The giant is wounded. For decades, the world ran on one simple rule: trust in the United States. The US dollar was the global currency. The US military was the global protector. US markets were the safest place to invest. This trust was the invisible pillar holding up America's global dominance. Now that pillar is cracking. This is stage 6, the loss of trust, and it's happening faster than anyone imagined. Nations around the world are starting to quietly prepare for a future where America is no longer in charge. This movement has a name: de-dollarization. For the first time in 50 years, major oil producers like Saudi Arabia are openly discussing selling oil in other currencies, a move that would strike at the very heart of the dollar's power. The BRICS alliance, Brazil, Russia, India, China, and South Africa, is actively building a parallel financial system to challenge American dominance. They are buying gold at record rates, a clear sign they are losing faith in paper promises. Allies who once huddled under America's protection are now questioning its reliability. This is the quietest but most dangerous stage. It's not a loud declaration of war, it's a silent, global recalculation. The world is placing its bets elsewhere, sensing that the empire's credit is running out. You don't have to take a historian's word for it. Perhaps the most terrifying warning comes from a man who deals not in history, but in cold, hard numbers. The billionaire investor, Ray Dalio. Dalio has made a fortune by analyzing data to predict major economic shifts. A few years ago, he turned his powerful computers to a new question: what causes empires to fail? His team studied every major empire of the last 500 years, and his findings were identical to Glob's, but with a terrifying modern precision. Dalio revealed that all collapsing empires show 3 clear signals at the same time. First, they have astronomical levels of debt and are printing huge amounts of money. Second, they have political polarization. And third, they are challenged by a rise. The United States is the first country in its history to be flashing bright red on all 3 of these markers simultaneously. The debt is skyrocketing, the political division is at its worst since the Civil War, and China has emerged as a formidable economic and military rival. And coming from a historian is a theory. Coming from one of the world's most successful capitalists, It's a 5-alarm fire. So what comes next? What is stage 7? It's not the Hollywood-style explosion most people imagine. It is the great unraveling. It's the moment the system can no longer support its own weight. It's not one event, but a cascade of failures. It begins when the debt market freezes, because no one wants to buy the bonds of a bankrupt nation. The currency collapses, not overnight, but in a gut-wrenching spiral as global faith evaporates. Supply chains, once a marvel of efficiency, break down, leading to shortages on store shelves. Social order fractures as people, terrified and angry, look for someone to blame. Politics descends into pure vengeance. The institutions that are supposed to manage the crisis, the government, the central bank, the courts, are seen as illegitimate and powerless. This is the point of no return. You can't print faith. You can't pass a law to restore trust. The empire doesn't get conquered. It simply implodes, hollowed out from decades of decay. Rome became ruins. Britain became a museum. The Soviet Union became a memory. And each one of them believed, right up until the end, that they were the exception. The story of history is not a gentle whisper. It's a deafening echo. From Sir John Glubb's 250-year death clock to Ray Dalio's data-driven warnings, the message is the same. The stages are predictable. The patterns are clear. We see the poison of victory leading to overreach. We see the devil's bargain of a currency untethered from reality. We see the civil war of the mind tearing society apart, and we see the world quietly hedging its bets against us. The evidence is not hidden. It's written in our headlines every single day. History has handed us a map, a detailed guide showing exactly where the cliffs are. It shows us the path every great power has walked before, a path that always ends at the same precipice. We are standing at that edge right now. The final, terrifying question is not whether the pattern is real. The question is, are we even looking at the map? What if the greatest financial disaster in American history wasn't an accident? What if the 1929 stock market crash, the event that wiped out millions of families and plunged the world into the Great Depression, was actually an orchestrated demolition? While newspapers were promising endless prosperity and ordinary people were pouring their life savings into the market, a small elite group of insiders wasn't just quietly heading for the exits. They were lighting the fuse and positioning themselves to collect the profits from the explosion. This isn't a story about a market crash. It's a story of the greatest wealth transfer in modern history. And it exposes a brutal truth about how the world really works. The story everyone knows about Joseph P. Kennedy, patriarch of the famous American dynasty, is almost a comforting fable. The tale goes that he knew it was time to get out of the market when his shoeshine boy started offering him stock tips. It's a great story because it makes him seem relatable, like he was just a savvy guy who saw a clear sign. But the real story is much darker and far more calculated. Let's be real. Kennedy didn't need advice from a shoeshine boy. He understood the system was a house of cards because he was one of its architects. Before his days as a celebrated ambassador and political figure, Kennedy was a master of the Wall Street underworld, notorious for running stock pools. These were essentially legal scams where a group of powerful traders would secretly conspire to buy a stock, inflate its price through manipulated trading, a practice called painting the tape, and then dump it on an unsuspecting public right before it crashed. He knew the game was rigged because he had rigged it himself. Summer of 1929, when he saw the same manic, uninformed buying from the public that he himself used to exploit, he didn't just see a warning sign. He saw an opportunity. Kennedy didn't just sell his stocks. He quietly liquidated his entire portfolio, converting it to cash and gold. But that wasn't the whole story. He then took that fortune and began to bet against America. He started short-selling stocks on a massive scale, positioning himself to make a killing when the very system that made him rich finally came crashing down. But Kennedy wasn't the only one preparing for the storm. There was another, more mysterious figure operating in the shadows of Wall Street, Jesse Livermore, a man they called the Great Bear. Livermore wasn't an insider in the same way Kennedy was. He didn't have a network of powerful friends in boardrooms and banks. Instead, he had something more potent, an almost supernatural understanding of market psychology. He saw the Roaring Twenties not as an era of prosperity, but as a textbook case of mass hysteria. He once wrote, "The public is always wrong." And in 1929, he decided to bet his entire career on that single belief. Throughout the year, as stock prices hit one dizzying new high after another, Livermore began building an enormous short position. The media called him a traitor for betting against American success. But Livermore ignored them all. He worked in seclusion from a luxurious, heavily fortified office, surrounded by telephones and ticker tapes, meticulously gambling. He was a general planning an ambush, waiting for the enemy to march right into his trap. He understood that once the panic started, it would feed on itself in a vicious cycle of margin calls and forced selling. And when that day came, he would be ready to profit from every single moment of the carnage. While figures like Kennedy and Livermore were making their personal moves, the market itself was sending out secret signals, whispers of doom that only the financial elite could hear. For months, a strange divergence was happening that baffled most observers. While the stock market was soaring to record heights, the bond market, the boring, safe world of government debt, was getting stronger. This made no sense. Normally, money flows out of safe bonds and into risky stocks during a boom. But in late 1929, the opposite was happening. Sophisticated investors, the old money families, and European banks were quietly selling their stocks and pouring the cash into the safety of US government bonds. It was a silent vote of no confidence. At the same time, money from overseas was fleeing America. British and German investors, watching the frenzy from across the Atlantic, knew a bubble when they saw one. They began liquidating their American assets throughout September and October, pulling their capital back home before the inevitable collapse. Perhaps the most damning signal came from the Federal Reserve itself. The central bank had been steadily raising interest rates throughout 1929, making it more expected. This was just boring financial news. But to insiders, it was a clear message. The Fed was deliberately trying to pop the bubble. They were willing to induce a correction, knowing full well it could spiral out of control, just to purge the wild speculation from the system. The easy money was over, and the people in charge were the ones turning off, hidden deep within the market's plumbing. The crash of 1929 wasn't just so devastating because stocks were overvalued. It was because the entire system was built on a pyramid of debt. The culprits were new financial inventions called investment trusts. They were sold to the public as a safe way to invest, similar to modern-day mutual funds. But behind the scenes, they were ticking time bombs. Here is how the scheme worked. An investment trust would borrow huge sums of money to buy a portfolio of stocks. But it got worse. Buy shares in other investment trusts, which were also borrowing money to buy stocks. It was leverage built on top of leverage. A financial Jenga tower where every block was a loan. The smart money understood this perfectly. They knew that as soon as stock prices began to fall, this whole structure would collapse with breathtaking speed. The trust would get margin calls from their lenders, forcing them to sell their best stocks to raise cash. Those sales would drive prices even lower, triggering more margin calls for other trusts, in a death spiral that would become completely unstoppable. The system wasn't just flawed, it was designed to self-destruct. In the final 48 hours before the crash, the secret activity among the elite reached a fever pitch. While the public was still being told to buy the dip, the insiders were engaged in a frantic, coordinated escape. This was their last chance to get out before the doors slammed shut. Corporate executives, the very people running America's biggest companies, were quietly dumping their own personal stock holdings in record volumes. They knew their company's real financial situations, and they could see the economic storm clouds gathering on the horizon. They smiled for the cameras and issued reassuring press releases, then picked up the phone and told their brokers to sell everything. Meanwhile, in the private, smoke-filled dining rooms of Manhattan's most exclusive clubs, the true titans of finance held emergency meetings. These weren't social calls, they were war councils. They shared insider information, discussed which banks were most exposed, which companies were carrying too much debt, and finalized their exit strategies. They used private telegraph lines and fleets of messengers to execute their trades, bypassing the public communication systems that were already beginning to lag under the immense volume. They had a two-tiered system, one for them and one for everyone else. They weren't just guessing about the future, they were creating it, ensuring they would be the ones left standing when the dust settled. Then came Black Tuesday, October 29th, 1929. For millions of Americans, it was a day of pure horror. A day their life savings, their dreams, and their futures evaporated into thin air. But for the insiders, it was not a crash. It was a harvest. As the ticker tapes reported catastrophic losses and panic swept the floor of the New York Stock Exchange, Jesse Livermore sat calmly in his office watching his calculations play out with mathematical precision. As the market plummeted, the value of his short position soared. In a single week, he made over 100 million, the equivalent of more than 1.5 billion in today's money. He had single-handedly profited more from the collapse of America than almost anyone had ever profited from its success. Joseph Kennedy was also counting his winnings. Not only had he protected his entire fortune from the crash, but his short positions paid off handsomely. Disaster would become the bedrock of his family's wealth, financing his children's political ambitions and building a dynasty that would shape the 20th century. This wasn't a loss for everyone. It was a brutal, calculated transfer of wealth from the optimistic, uninformed masses to the cold, cynical, and well-connected few. The party was over, and the insiders were the only ones who got paid, but the story doesn't end there. And for the man who profited most from the crash, there was no happy ending. Jesse Livermore, the genius who had outsmarted the entire market, found himself in a battle he couldn't win. The one against himself. Though he had made a legendary fortune, his life after 1929 was a slow, agonizing descent into chaos. He was a master of market cycles, but a slave to his own emotional ones. He lost his massive fortune in subsequent market downturns, got married and divorced multiple times, and battled severe depression. The man who could stare down the financial world with ice in his veins was haunted by personal demons he could never conquer. In 1940, in the cloakroom of a Manhattan hotel, Jesse Livermore, the Great Bear of Wall Street, took his own life. His final note read, "My life has been a failure." He had won the ultimate prize, only to realize it meant nothing. He had mastered the game of money, but had lost the game of life. His tragic end serves as a chilling reminder that profiting from disaster carries its own kind of cost, one that can't be measured in dollars and cents. The Great Crash of 1929 was never just a random event on a historical timeline. It was a lesson written in the language of greed, fear, and brutal opportunism. It revealed that the market is not a level playing field. It is a complex logic can exploit the predictable emotions of the crowd. While millions of ordinary people were ruined by a collapse, they were told to happen. Coming didn't just survive, they thrived. 95, there was interest for months to strangling exports, and destabilizing global trade. Power in power century and with inflation, interest rates, and currency manipulation. This isn't theory, it's history.